So you're thinking about moving to Fayetteville, North Carolina? Well, in this video, we're going to talk to you about the predictions of the real estate market here in Fayetteville, North Carolina. But you want to stick around to the end of the video so you don't miss any of the important information that we want to share with you about this great city. If this is your first time to our channel, you want to go ahead and like and subscribe and hit that notification bell so you can be the first to receive all of the current market information that we want to share with you about the great city of Fayetteville, North Carolina. My name is Michelle Capers and I'm the broker in charge of moving forward real estate. And believe it or not, we get calls and texts and emails from clients just like you on a daily basis looking to move to this great city. Now, whether you're a buyer or a seller or even an investor looking to move in 90 days or 9 months, give us a call, shoot us a text, or send us an email, and all of our information will be in the description box below. We want to help you make a smooth move to this great city of Fayetteville, North Carolina, Cumberland County, and its surrounding areas. Now let's get into this video. Now, experts predict that the North Carolina housing market will continue to slow down in 2023. Now, the homes are expected to rise by 2 to 3%, but the number of homes for sale will continue to increase. Now, this will lead to more competitive bidding wars and longer days on the market. Now, let's discuss some topics of concern. Will the home prices drop in the 2023 recession? Most experts do not expect the housing market to crash in 2023 since most of the homeowners have built up a significant amount of equity in their homes. The issue is primarily an affordability crisis. Higher interest rates and inflated home values have made purchasing a home very challenging for first-time home buyers. Another question asked is, should I buy a house now or should I wait till after the recession? Now, if the news of a potential recession worries you, it may be best for you to wait, particularly if your main source of income is susceptible to an economic downturn. Just like you can't time the success of the stock market, trying to time the real estate market is just as futile. Now, with that being said, will 2023 be a good time to buy a house or not? According to the CAR's monthly Consumer Housing Sentiment Index in April of 2023, it shows that 59% of the consumers said it is a good time to buy, and that percentage was up about 55% from last year. Only about 25% of consumers feels that now is a good time to buy, and that was around the same percentage from last year. Now, you may be asking, what is the best time of the year to buy a house? Late summer, specifically around the August time frame, it tends to be a better time to buy a house rather than the earlier summer, as there's more likely to be a healthier balance between the inventory and the prices. Now, in June and July, many of the housing markets still have a strong demand of inventory levels carrying over from the spring, and that gives the sellers more of an advantage. Now, what time of the year is the housing market the slowest? Sellers can net thousands of dollars more if they sell during the peak months of the year, which is May, June, and July, versus the two slowest months of the year, which is October and December. And this is according to the 2022 report of the Adam Data Solutions. Now, during the height of the pandemic, normal seasonal patterns all but disappeared from the housing market. There was so much of a demand for the houses that any time was a good time to sell your home. Now that the market is settling down somewhat, timing once again is becoming an important consideration for home sellers. Some patterns and trends usually do hold true throughout the year, and one of those is the late spring and early summer are the best times to sell again. Sellers can net once again thousands of dollars more if they sell during those peak months, which is May, June, and July, versus the slowest months, which are October and December. So just keep that in mind. Homes sold in May net about 12.6% a seller's premium above the normal home market value. Now, this is based on the Adams analysis of single-family homes and condos sold over the past 10 years. Another question that we get is, will a recession crash the housing market? Now, in the event that the U.S. does fall into a recession, the interest rates will likely dial back somewhat, which could cause mortgage rates to ease slightly. But the housing market will still likely be affected by the weakening labor market and the ongoing crunch in credit conditions. Now, how long does a recession normally last? Well, about 10 months. And the good news is that the recessions haven't lasted very long. Our analysis of 11 cycles since 1950 shows that recessions have persisted between 2 to 18 months, with the average spanning of only about 10 months. Now, for those directly affected by job losses and business closures, this can feel like an eternity. Another question to consider is, does the mortgage rates go down in a recession? Another factor is that the recession often comes with reduced economic activity and higher employment rates. Now, this means that there is less demand for mortgage financing, which means that less demand and interest rates decrease. Now, let's discuss some things not to do in a recession. Number one, you don't want to become a co-signer for anyone. You don't want to become obligate yourself to become a co-signer for someone, because then that will put an extra burden on you. And it could be a loved one, a friend, someone that you trust. It doesn't have to be something wrong with this person or anything like that. It's just that things happen, and it could be a situation that they don't even have control over. They could have lost their job, and what that does is that puts you in a position where you now have to take on the burden of that car note, of that loan, line of credit, whatever it is that you co-sign for them for, in addition to your bills. So that could become very stressful for you, even though we love our friends and our families. Just at this point in time, with the economic imbalance it would not be advisable for you to co-sign for anyone at this time. So the second thing you don't want to do at this time is get an adjustable rate mortgage. We call that an ARM, an ARM, the ARM mortgage. And the reason for that is because your rate, once you close on your loan, your loan could be at a 2%, 3%, 7%, and as time goes on, your rates will increase. So you don't want to do that at this point in time, because again, you could have a job loss, or you can have a decrease in income. What happens is that your interest rate is going to increase in time. So the longer you keep that loan, keep that home, your interest rates are going to go higher. So you don't want to get yourself in a position where, if there is, just say, two incomes that is in the family, your spouse and yourself, or a roommate, or whatever, and you lose one of those incomes, and you are dependent on that income to support your mortgage, definitely put a strain on you to have to pay more for your mortgage, but now you have less income coming in. So number two, you don't want to get an adjustable rate mortgage at this time. Number three, another thing that you don't want to do in a recession is assume any more debt. Don't go out there and start getting yourself into more debt, applying for credit cards and loans and vehicles. If you need a car, then you go ahead and do what you need to do. But we're talking about, as it stands right now, whatever you have going on, let's try to maintain what you have going on, because again, you could definitely fall in a situation, which we're praying that you never do have to deal with this, but there could be a job loss, or you could have a loss of income of some sort, a decrease in income. Maybe you have to shift jobs, and now with this job, you're making less than what you were making on your other job. So you don't want to go out there and just start adding more debt to what you already have. And even sometimes, you might get a raise, and it might be, because we always think that it's something bad that could happen, but then you could actually have a raise, so you have a little buffer, you have some an increase in your income, and sometimes the more we make, the more we want to spend. So what we're saying is that even if you fall into that category and you're starting to make a little bit more right now, that's to be able to get promoted on your job, you want to be able to maintain that, put those monies away, and don't go out there and start accumulating more debt. So again, number three, you don't want to get yourself into more debt than what you have. Do not assume any more debt than what you have at this time. So number four, you don't want to take your job for granted. Yes, we are all blessed and grateful to have a job right now and job security. But right now, we don't know unless you're in the military, and that's pretty much, you have job security, but you still want to be wise in your spending. But, when you are a civilian, you don't want to take your job for granted, because it doesn't matter how long it's been around. There's a possibility that it could close someday. So you just don't want to get into a position where you think that you're secure and you're safe. Please take the necessary precautions and take advantage of the times that you do have, and you do have the increase, and set aside some funds to save or invest, or whatever you need to do at this point to build yourself some type of security just in case. Let's not take for granted that your job is going to always be here. Now, the fifth thing that you don't want to do is to make any risky investments. Now, we all want to make more use of our money and get more bang for our buck, for our money, with our monies that we have, but you don't want to take your retirement or savings that you have been working so hard for and put it in any type of vehicle where it may be risky, where there's a possibility that you may lose it all. Be careful and do your research, and definitely do your due diligence on where to place your money, because again, at this time, it is so risky out there, and it will be awful, and heart-wrenching for you to take all your money, your retirement, 401k, savings, and put it into a vehicle hoping to. You don't want to end up losing everything that you have and worked, years, 20 years and so forth, in 20 days or so, or even less, off of a quick decision because of desperation. So again, number 5, you want to not make any risky investment deals at this time. So now let's talk about how to prepare for a recession. Now, number 1, you want to create an emergency fund. An emergency fund is an essential tool for managing risk and uncertainty. So again, you want to put some money aside, from your paycheck. Each paycheck, try to go ahead and save. Don't just splurge and spend everything extra that you have after you paid your bills. Go ahead and put some of those monies aside. That is a wise thing to do. And you want to do that at all times in your life, not just in a recession, not just because something is a threat. You always want to put some money aside for those rainy days. So number 2, you want to go ahead and cut down on expenses. So if you have been promoted, or you have some extra money coming in from your taxes, or inheritance, or whatever, you have some extra income coming in, you want to utilize that money to your advantage. You want to go ahead and take the extra money as much as you can and pay off as much debt as you can. Focus on getting yourself out of debt at this time, and this is just a good practice at any point in time. Once you get extra money, again, just because we make more money, that doesn't mean that you need to spend more money. Go ahead and take that money, that extra money, and take advantage of it and start paying down as much debt as you possibly can. So number 3, you want to look for additional sources of income. You want to look for ways of creating more income. Multiple income streams is really vital at this point in time. And, and it's always good, because if something goes bad and you lose a job, then you have something else to fall back on. So you want to look for opportunities, or look for other interests in your life that you can, incorporate in what you're doing right now. It's something that it can kind of run itself, that it's not monopolizing and taking up all of your time. Again, number 3, you want to create additional sources of income for yourself. And the 4th and final topic that we have is don't panic. We don't want you all to get out there and get fearful and start, predicting possibilities of things that could or may not even happen. What we want to do is convey to you some things that will better prepare you in a recession or any type of unfavorable time. So what you want to do is save more and spend less at this time. Just be wise in what you're doing, wise in your spending. We don't want this information to bring about fear in you in any type of way. Overthink this. In other words, again, just don't panic. Save more and spend less. Now, we hope you learned something in this video today. If you have, drop us some comments in the description box below. And if you have any systems that you have put in place that is working for you, go ahead and please share it so you can be a help and a benefit to others as well. As always, we are moving forward one home at a time, and we look forward to seeing you in the next video.